Hello and welcome to this special edition of Young Turks, Back to the Basics. I'm Shireen Bhan. Now on the show today, we're looking to put into perspective the goings-on in the e-commerce space in India. The malaise has been around for a while with murmurs of an impending meltdown doing the rounds as some of the biggest players have found it difficult to raise funds. While valuations have taken a significant cut, in fact the latest markdown was by Fidelity that cut the value of its shares in Flipkart by 36%, valuing the company at $5.5 billion. That's down from a whopping $15 billion just 2 years ago. Now, the continued losses at Flipkart seem to have prompted its single biggest shareholder, New York-based fund Tiger Global, to install Krishna Krishnamurthy in the CEO's office, replacing founder Binny Bansal. Adding to the woes, 2 weeks ago, Japan's SoftBank wrote off $475 million in combined value of its shareholding in Ola and Snapdeal, its biggest investments in India. And this brings us to Snapdeal. Just yesterday, the company announced that it is realigning its resources with a continued focus on efficiency and profitability. Now, what that essentially means is that Snapdeal is going to be cutting down on operations. They will be forced to make choices that will hopefully bring down costs for the company, and they will also be forced to retrench people. Now, that is the hard one, because they are going to have to let go, from what we understand, anywhere between 300 to 600 people. And they are expected to do this in tranches. In the first tranche, maybe 300 people are going to be asked to move on with a 3-month severance package. In fact, an acknowledgement of the trouble at Snapdeal has been articulated in a letter that the founders have written to their employees. Now, before I get to the letter, why this letter is important? Because it addresses not just the trouble at Snapdeal, but it also gives you a sense of the problems facing India's startup ecosystem. It's important for us to read out some crucial excerpts of that letter that give us a sense of what the problems are. Let me start by the first excerpt. Has our company and industry been going through troubled times? Absolutely. Did we make errors in our execution? No doubt about that. So that is an honest acknowledgement that there have been strategic misadventures at Snapdeal. Is Snapdeal the only company guilty of that? That, of course, is a different story. Others have followed suit as well. They go on to say, over the last 2-3 years, with all the capital coming into the market, our entire industry, including ourselves, started making mistakes. We started growing our business much before the right economic model and market fit was figured. We also started diversifying and starting new projects while we still hadn't perfected or figured out the first or made it even profitable. We started building our team and capabilities for a much larger size of business than what was required with the present scale. As I started out by saying, this is not a Snapdeal specific problem. The problems of diversification, of trying to grow too quickly, too fast, too much capital, chasing too few companies, is something that we've seen plague the Indian startup ecosystem over the last few years. They go on then to say that we started building our team and capabilities for a much larger size of business than what was required with the present scale. We've also seen these jaw-dropping salaries, compensation packages being given out, when, remember, the rule of starting up is to stick with the basics. The rule of starting up is delayed gratification, and that is how profitable, sustainable companies are built. They then go on to say a large amount of capital with ambition can be a potent mix, and this is the entrepreneurial dilemma, isn't it? Because it's ambition that drives a company to perform, but it is a potent mix of ambition with capital that forces companies to defocus, and that's what happened at Snapdeal, and that's what we've seen happen at several other companies. We started doing too many things too soon. So this problem, the perils of diversification, of spreading yourselves too thin, is what we've seen play out across several companies. And where does this all lead us to? At the end of the day, here's what the Bansals have to say. We need to keep our heads down, focus all our energy on execution, and this will mean tough choices and a conscious departure from a Me Too race to the edge of the cliff. Let's remember, they say, GMV is vanity and profit is sanity. If only these founders had taken their own advice that they're now dishing out. But as we've been saying, these are young teams, these are young entrepreneurs, too much capital. We also should recognize the fact that there was an irrational exuberance, perhaps, with venture capitalists believing and investors believing that all would eventually work out, and maybe some degree of rationality is now emerging, which is good for the startup universe. Now, let's just tell you how the numbers stack up. Because all these years, these entrepreneurs have been talking about GMV, and now they're talking about cash and profitability. So let's just take a look at FY16, for instance. Revenue for Snapdeal at 1,457 crores, for Flipkart, 1,952 crores, Amazon, 2,275, ShopClues, very, very small in comparison, 179 and 197, which is Paytm, 920 crores. But let's look at this line now. Look at the losses mounting. 2,960 crores, that's the loss for Snapdeal in FY16. 2,306, the loss for Flipkart. 3,572 Amazon, it has the deep pockets. 383, again, very small for ShopClues, and 1,549, that's what's happened as far as Paytm's losses are concerned. Ad spends, 1,478 crores for Snapdeal, 923 crores for Flipkart, 2,164 crores for Amazon, and 1,546 crores there as far as 197 is concerned. Total funding of 9,750 for Snapdeal, 9,818 crores for Flipkart, 11,671 crores there for Amazon, and 4,860 crores there for Paytm. So these numbers tell you the story, and this is why companies like Snapdeal are now being forced to take the tough choices that they are having to take. Now, the argument has been discounted. We've seen a lot of people talk about what needs to be done now to build out the nascent online retail market, encourage consumers to go shopping online and so on and so forth. But the discounting trap to grab market share has proven to be a vicious one, with each player focusing to outdo the other on big sale days and perhaps lose sight of the basics of any strong business: good customer service and a clear focus on keeping your costs down and an eye on profitability. We caught up with industry veterans and investors to find out what they made or what's happening in India's e-commerce and consumer tech space.
In the initial stage of the startup ecosystem developing in the country, a lot of free money came into the system. So there are greedy investors who are pumping in more money than required into the companies and telling them to go aggressively and grab the marketplace. In the whole process, the management forgot there is something called profit and cash flows. So in the urge to get more of market share, they forget the fundamental things. And most of the consumer tech companies, not only Snapdeal, many of the large companies are in the same position. Today, with the money drying up and investors focusing on profitability, I think these guys have to take the tough decision. It's a good churn to happen.
I think the key issue which has happened is there has been irrational exuberance. Valuation moved ahead of value creation. Valuation has now corrected. It will wait for value creation to catch up with valuation before the next thing comes. And many of the companies now will have to be marked down deeply, almost sold at bargain prices. And maybe new investors will come and put in money and take a larger stake and dilute everybody else out of existence. And maybe they'll put in a new team to take it up. I mean, this is the nature of the beast. We should not be surprised. This is the way venture works, this is the way the industry works, and this is the way we're going to see waves of it in future.
Venture capital is an industry that grows in waves, and we've seen one wave. This one has ebbed a little bit, and there's other waves building. So I think we should just bear in mind that we've actually graduated a whole generation of customers into being digitally savvy and comfortable transacting online, and we have to thank investors for underwriting that. So I think in a lot of ways, now we see a next generation of entrepreneurs who will have learned from these mistakes.
But some investors, they're talking about the challenges and the problems and why we're facing the situation that we currently are today in India's startup ecosystem. Too much capital, too aggressive in too little time, not enough profitability or a plan or a path to profitability. The lesson really is to keep your eye on the ball at all times. The lesson is to stay focused. The lesson is to narrow your focus and specialization. It's time now for us to take a break. But when we return, we'll tell you the do's and don'ts of doing business the right way. We catch up with Rajiv Bajaj on the other side on the rules of playing the game right.